My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends, just trying to make a little money. My job is not just to entertain, but to educate, teach, put days like today in context. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. The growth selling may be over, and the value selling may have begun. Hey, that's my takeaway from today's action. A good day where the Dow gained 406 points, S&P jumped 1.89%, and the growth-heavy NASDAQ rallied 3.41%. Yep, Wall Street's once again discovering why we like growth and why we've disliked value for years on end. So allow me to explain the timeline. For almost this entire month, two things were self-evident. Growth is dangerous and value is safe. The growth stocks had gone untethered right as the Federal Reserve decided to start raising interest rates. And we know that historically higher rates are a huge headwind for growth names. It's been a true nightmare for growth investors, a nightmare that we've been trapped in since Jay Powell turned hawkish in late November. Somehow, though, many investors didn't get the memo that growth had gone out of style until Netflix reported. And, of course, Netflix imploded, and that was a week and a half ago, reporting an unexpected slowdown that caused the stock to immediately shed more than 20% of its value and bring down a whole cohort that's gigantic. But in retrospect, the pain has been so intense for so long that rather than marking the beginning of the big growth sell-off, I am beginning to wonder whether the Netflix meltdown was more like the denouement. Why? Because one by one, we had big industrial value plays, GE, 3M, Boeing, and Caterpillar, report subpar numbers that made us question the legitimacy of the value rally. These companies are all feeling the sting of supply chain woes, inflation, port congestions, and worst of all, COVID. Yes, they had to work hard to staff or to overcompensate their freight needs. The deep integration of semiconductors into every aspect of industrial production surprised us, made us realize again that these manufacturers need older chips that in many cases have been phased out. Sure, they were being produced, but not nearly as many as we need. Oh, and those pesky port problems, they're at the heart of the supply chain crisis. Finally, COVID. These aren't the kinds of companies that can send their people home to work from home. They need the workers to show up at the factories in person. But those factories became breeding grounds for the virus. Put it all together, these industrial value stocks suddenly looked a lot less like safe havens than people thought they were. But that wasn't enough to turn this whole market on its head. What the growth cohort needed was to remove the sting of Netflix and the Fed's harsh turn to make that happen. They needed a champion, a reminder that growth can still produce good results. And you know what? It came along in the form of ServiceNow. Yes, we got it last Wednesday when ServiceNow reported a tremendous quarter, one devoid of supply chain woes, COVID problems, port congestion, delays, semiconductor shortages. Those were all the problems of the so-called value industrials, not a cloud-based software stock like ServiceNow. At the same time, Boeing reported, and it had every problem under the sun: labor costs, raw material costs, inflation, something you never see from growth stocks, nasty cost overruns and charges. Oh, Cal, I had conversations with Boeing and conversations with ServiceNow, and they were so different. Bill McDermott came on Squawk on the Street, and he was so bullish. The amount of business ServiceNow is doing. It was a stark contrast, the juggernaut ServiceNow versus the grounded entity that is Boeing. Now, the night before, Microsoft reported the growth haters came out in full force, betting that there had to be something wrong with the quarter related to Azure, their cloud business. The stock initially got clocked for 20 points, sinking to the 270s in after-hours trading. But when CFO Amy Hood calmly had some very good things to say about Azure, midway through the conference call, knowledgeable buyers took Microsoft right back up to the 290s. Again, no ports, no COVID, no semiconductor issues. Thursday, we got the coup de grace, Apple, which delivered an astounding quarter with only one small product line dinged by production woes. Yes, inflation was mentioned, but it didn't really play a role. And management did say that any product shortages had already been solved for the first quarter. A great company that makes things and makes profits. But at the same time, a fintech, one of the older ones, but a fintech nonetheless. MasterCard reported an absolutely blockbuster quarter, and he even mentioned the cross-border business was picking up. That's travel-related business. It's a COVID reopening play with no supply chain, no semiconductor issues, no factories to get sick at. Then on Friday, Robinhood, the poster child for disappointing growth names, reported an awful quarter, one of the worst of the year, yet its stock is up higher. Now, we didn't learn until later that night that Cathie Wood, Wall Street's highest profile growth manager, was creating a bottom herself with her investing, but the fact that she could even do that mattered tremendously. Then Chevron, the darling of the value bulls, missed numbers. Now, how is that possible given the rise in oil? Well, turns out there's a whole lot of moving parts to owning the oils. It was a rude awakening that value in the oil patch is mighty hard to understand. Now, let's go full circle. Today, we learned that Netflix CEO Reed Hastings bought $20 million of his own stock at an average price of $388, a nice discount from today's $427 price. Oh, why would Hastings do that? Doesn't he know that streaming services are stuck in the mud? I think the answer is simple. Insiders only buy for one reason, because they believe their stock's going higher. Does he know more than us? He's a CEO, yeah, I think he does. Oh, and a reminder, remember how the growth stock sell-off started a long time ago, back in November? Do you know that Netflix traded as high as $700 back then? This company with huge pricing power and a full set of content coming out post-COVID had a stock down 50% at its lows last week. 50%, that was cut in half. What else? Just when we thought that the bulls had deserted Tesla, we got a new convert, Credit Suisse. Incredibly thoughtful piece about how Tesla's still the real winner in what could arguably call the newest industrial revolution, the end of the internal combustion engine and the rise of electric vehicles. Great hold to buy. And what may have been the exact bottom of growth, perhaps the appearance this very morning, on Squawk Box, of Matthew Tuttle, the creative guy who fathered an ETF that bets against Cathie Wood, or Woods, as he called her, with a fund that had gained 61% since the peak of growth investing in November. Bulls make money, bears make money, but pigs, slaughtered. How long can this growth rebound rally last? Arguably, as long as value stocks have to deal with supply chain, semiconductors, and COVID worries, they remain naughty. Plus, there's been a virtual shutdown of the IPO pipeline, which was filled with all sorts of software as a service analytics companies that save time and labor with real-time dashboarding and great onboarding. SPACs, they're now being bashed left and right as wastes of our money. Take away the new supply of bad growth that makes nothing, Gresham's Law, or sells next to nothing, and the real growth stocks can shine. Now, I've never been a true believer in this growth versus value dichotomy. I prefer to look for quality companies with great management, regardless of which category they belong to. I don't want companies that make excuses, even when those excuses make sense. Anything that results in a number cut is a nightmare. Beat and raise will always take precedence for me. I want companies that make things and make a lot of money doing so. At this point, there's so much money invested in value stocks that it won't be an overnight shift. And I'm sure some industrials have been able to overcome the problems. Otis Elevator had no supply chain or semiconductor issues. They reported some numbers today that were initially looked down upon because of some Chinese order weakness, but then the stock snapped right back. I think that's because it didn't have these curses. But I'm betting that's a rarity. Meanwhile, two big semis, Cirrus Logic and NXPI, both reported fantastic quarters tonight. Unlike 3 weeks ago, these were immediately greeted with higher prices in the aftermarket. The bottom line, if you want a value stock here, pick one where we know there aren't any supply chain, semiconductor, or COVID woes. Otherwise, it's going to be tough without owning some predictable, profitable growth. George in California. George.
Hey, Jim, thanks for your valuable work on behalf of retail investors. I'm a charter member of the CNBC Investing Club, and the information from members is excellent.
Oh, you're terrific. I hope you watch the 1020 morning meeting. We have such a good time doing it.
I do. It's terrific.
Oh, fantastic.
Thank you.
Fantastic. Thank you. And look forward to maybe later this week when we have our call. What's going on?
So my question is about semiconductor maker Skyworks Solutions. The company did very well last year, but with Apple as one of its largest customers, how at risk is Skyworks if Apple, as reported in the press, plans to replace Skyworks chips with Apple's own chips?
Well, look, that's always a probability. Skyworks is doing incredibly well. Liam Griffin is doing incredibly well. I'd like to think that, given what I've seen from Cirrus Logic and NXP Semi, that you can own Skyworks here. So I would own it going into the quarter, which is later this week. on the 3rd. How about Patricia in Illinois? Patricia.
Hi, Jim. Investment Club member.
Oh, thank you.
Just wanted to tell you quickly that your wife is a lucky woman to be married to such a smart guy.
Oh, well, that's very kind. I may have to just record that and put it on Twitter, where she will most certainly not see it. Go ahead.
My stock is Skin. You recommended it about 6 months ago. I bought it at about 17. It's trading today at 14.20. Should I buy more or just hold?
I actually went to my unbelievably brilliant dermatologist this weekend to say, does this thing work? The actual device they have, she said, is terrific. The stock is a SPAC. And because it's a SPAC, it goes down. I think had they bought this through a traditional IPO, it would do well. But I know this, Beauty Healthcare does have a real product. It has a new CEO, and I would not sell it at this level, even though it is a SPAC, because it actually may be worth something. Right? I've never been a true believer in this growth versus value dichotomy. I prefer to look for quality companies with great management, no matter what category they belong to. If you want to pick a value stock here, pick one where there aren't supply chain, semiconductor, or COVID woes. There's some out there. Take those. Well, man, tonight, after reporting a top and bottom line beat for the fourth quarter, could Cullen/Frost Bankers be the regional bank that could continue to work in this market? I like these guys. I'm checking in with the company's top brass. And what effects could quantitative easing have on a host of commodities? I'm going off the charts to find out, and it's a little different than you thought. Plus, Silvergate Capital has tied itself to crypto. But given the recent volatility in the space, what should you make of the legacy bank now? I've got the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.